Why so many banks falling in the US? We recently witnessed the debacle of Silicon Valley Bank and Signature Bank in US. The failure of these banks exposed the US financial system and raised the question on the soundness of banking and financial industry and regulator. What causes the bank run in US? Why these banks are become insolvent? First, let's have a look on banking industry of US. Banks give us a safe place to store our cash, facilitate fast electronic payments to people and businesses thousands of miles away, and lend us money to finance big purchases we can't afford all at once. According to the Federal Deposit Insurance Corporations, there are currently 4,844 insured commercial banks in US at the end of 2021. The finance and insurance industry aids $2 trillion to US GDP and accounts 7.4% of country's total GDP. The 2022 gross output of the financial services industry was $3.6 trillion. Bank do fell from 2011 to 2020. The FDIC closed more than 200 banks, but they were small. All but 10 of these 200 had assets of less than $1 billion and the biggest was $6 billion. US Bank's sudden demise brought up many questions about tech startups, venture capitalism, the crypto industry, risk appetite, global capitalist system in general. In 2023, the first US banking institutions that was experiencing financial difficulties was Silvergate Bank, which was heavily focused on the crypto industry, announcing on March 8 that it would wind down operations due to heavy losses in its loan portfolio. The implosion of the crypto exchange FTX last year, once the world's second largest by daily transactions, primarily led to the demise of Silvergate since FTX was a major customer of the bank. Second came Silicon Valley Bank, which publicly announced difficulties on March 8, surprising the US financial world and investors since it was perceived a strong capitalized institution. SVP was at the heart of the tech region of the US. It had been a major source for venture capital, which is a form of private equity financing startups. However, SBP's fallout has begun at the end of February when some of senior officials of bank started unloading their shares. When SVP sold its $21 billion bond portfolio at $1.8 billion loss, and Baker announced on March 8 the bank has sold substantially all of its securities portfolio. Panic took over Wall Street and the US financial industry by storm. SVB had approximately $209 billion in total assets, around $175 billion in total deposits by end of 2022, and it was unusual for a well-capitalized institution to go under so suddenly. In less than 48 hours, the stock price of bank's parents firm SVB Financial fallen more than 60%, while its trading was halted multiple times due to high volatility. The scale of bank failures have hit by the US financial system are when looking at the total associate assets are alarmingly similar scale to those recorded in 2008. Albeit being caused by just two banks, Silicon Valley Bank and Signature Bank. This compares to 2008's 25 failed commercial banks. Major reasons for Silicon Valley Bank collapses: 93% of its deposit not insured. So much for the basic. Turning to the specifics of SVB risk management, the facts are now well known. In just 3 years, starting in 2019, SVB tripled its assets from $71 billion to $212 billion, or over 80% of its liabilities come from deposits, nearly all of which were large and uninsured. That is, the bank relied to an extraordinary degree on short term wholesale funding that could easily run. Furthermore, the bulk of SVB customers were part of tight connected group of startup entrepreneurs and their venture capitalists, making the bank highly vulnerable to sudden withdrawals if uncertainty arose regarding its solvency. On the asset side, SVB held over half of its assets, nearly $120 billion, in a combination of US Treasuries and government's guaranteed mortgage-backed securities. Importantly, a whopping 85% of these bonds had maturity of 10 years or longer. While these are free of default risk, they are not safe because their value declines sharply when interest rates rise. In fact, in its most recent SEC filing for the end of 2022, SVB disclosed that the weighted average duration of its fixed income portfolio was 5.6 years. This means that for each 1% point increase in interest rates across all maturities, SVB would incur losses of 5.6% of the value of its portfolio. Not only that, but over the course of 2022, SVP extended the duration of its securities portfolio by nearly 2 full years. That is, as the Federal Reserve aggressively raised the interest rates to combat inflation, SVP was increasing its exposure to interest rate risk. They were betting the bank that interest rates would not rise substantially further. A final aspect of SVB balance sheets also is important for this story. Aside from treating securities as trading assets that are always marked to market, banks can choose between two additional ways of accounting for securities that they purchase. They can either classify them as available for sale AFS or held to maturity HTM. For all but the largest banks, losses on AFS securities need not affect their profit or their reported net worth. For all banks, HTM securities are accounted for at cost, the price paid to purchase them, because these securities are not marked to market. Change in their market prices have no influence on the reported value of assets or capital. Of its 117 billion in marketable securities holdings, SVB treated $91 billion as a HTM and $26 billion as a AFS securities. So when interest rates rose sharply in 2022, they could keep what was $16 billion in unrealized losses from affecting the reported regulatory capital relations. Besides, other market conditions like Fed's aggressively hiking its rate also aid into the problems of banking industry in US. As the Fed hike its exchange rates, the funds and become more expensive and returns on the security substantially increase. The more and more of the customers and businessmen investing into the US Treasuries as compared to the depositing in the US banks. Additionally, the high rate of inflation also create problem for the banking industry. The peoples are looking more and more cash. Due to looking more and more cash to meet their demands, the people's withdrawing their deposits from the banks, and banking industry currently facing liquidity crisis due to hike in interest rates by Fed. US banks now facing $620 billion of unrealized losses on their books. The investment losses that helped take down Silicon Valley Bank are a problem to one degree to or another. Across the US financial system in total, the industry ended last year with 620 billion of unrealized losses on its books from investment in low-yielding bonds. Bonds held in investment books represented less than a quarter of banking system's 23.6 trillion of assets in December. And unlike SVB, lenders usually have a wide area of deposits who are unlikely to all need money around the same time. For the biggest bank, the risks are even smaller. They are perceived as too big to fail. What's more, the recent rally in Treasury bond market, sparked ironically by the jitters about the health of banking industry, is helping to shrinking the dollar 620 billion of paper losses. And yet, as the depositors keep gradually withdrawing their money and shifting it into money market funds and other investment, banks are facing a liquidity crunch. They are being pressed to pay more for funding while their revenue is limited by the investments they made in low yielding bonds during the pandemic. That is in turn could curb their ability to lend to consumers and businesses, slowing the economy. They are paying more for deposits and their earnings on bonds are fixed. When the pandemic hit and the Federal Reserve pushed down rates once again by pumping unprecedented amounts of cash into the economy, many banks loaded up on long term government and mortgage backed bonds. There were some treasury notes that promised to pay annual interest of just 0.6% over 10 years. Then inflation surged and the Fed started urgently driving up interest rates. The value of those bonds plunged. Because who would want to buy an old bond paying 0.6% interest when new ones were suddenly paying more than 3%? Losses on bonds are risky whenever rates go up, but banks' holdings were bigger than usual in 2022. All that cash the Fed and the government pushed into the economy quickly found its way into the banking system, giving lenders trillions of dollars to invest. As banks' deposits started to grow during the pandemic, they initially flowed more money into bonds using a method of accounting called available for sale. For these securities, changes in the value of the bonds would affect their balance sheet but not their income statement. That accounting method can force banks to boost their capital levels through if their losses get too high. Initially, it worked pretty well. Profits ballooned. The US banking system return on equity, a measure of profitability, averaged 12.2% in 2021, the highest since 2006. But now that inflation and rate hikes have come, banks have suddenly been finding themselves pressed from two sides. High interest rates forced banks to pay more money to win deposits, with average 1 year CD rates rising to about 2.7% by March, according to deposit accounting from 0.35% in May 2022. Consumers and companies have been taking more of their money out of banks and investing it into assets like government bonds. Deposits in commercial banks fell last year for the first time since 1948, according to the FDIC. The worst pain here is for community and regional banks, which lost more than $100 billion of its deposits in the week ended March 15, while the biggest banks have been losing funds. Meanwhile, the value of banks' bond holding plunged on paper too. The $620 billion of unrealized losses in the system at the end of 2022 were for available for sale and held to maturity securities. The combination of high investment losses and heavy deposit outflows caused trouble for banking sector. Who are responsible? Many analysts blamed a lack of management, effective leadership, corrupt management practices, and the inability of top executives to predict the potential impact of the turmoil in the crypto market last year. Many economists firmly believe that the Fed moved too fast and too high in rate hikes, withdrawing too much money from the global supply of the greenback and leaving the US economy without enough liquidity for new investment, especially in the tech industry. The safest and most typical investment action by banks under such aggressive monetary tightening is buying treasury bonds guaranteed by US government. Since they carry a low risk of default by the US government, they have a fixed interest rate with a small return. Because, however, tech startups were in dire need of cash last year due to falling aid-based revenues, venture capital funding was drying up and caused tech-heavy invested banks such as SVB to see their customers withdrawing deposits more and more. Larger withdrawals eventually cause any banks begin selling its own assets in order to meet customers' withdrawal demands. As a result, SVB was forced to sell its so-called safe bonds at a loss, and when these added up, it led to SVB become insolvent, a point when a bank cannot repay its deposits because its liabilities are greater than the assets that it owns. Currently, White House pushes new rules for mid-sized banks. The Biden administration urged banking authorities to tighten regulation of mid-sized banks, which it said could be pushed through without support from a split Congress. Banks with between $100 billion and $250 billion in assets should hold more liquid assets, increase their capital, submit to regular assets stress tests, and write living wills that detail how they can be wound down. The White House pushes for more regulations come 3 weeks after the collapse of US lender Silicon Valley Bank and Signature triggered market turmoil. Annual stress tests for banks in that range instead of every 2 years, shortening the time to apply stress test once banks reach $100 billion in assets, strengthening supervisory tools to ensure banks can withdraw rising interest rate. Thank you so much.